Hi, I'm Ross Healy, Chairman of Strategic Analysis Corporation. For the next few minutes, I'm going to use the principles of SVA, that's Structural Valuation Analysis, a unique methodology which visually combines fundamental with technical analysis to discuss and analyze the fortunes of a few of your favorite stocks, and by implication, the fortunes of your portfolio. So, let's get started. Let's start with Alphabet. In some respects, this is the easiest of all of the FANGs to analyze, because you see, for the past 10 years, this stock has traded between two major breakpoints on our chart. The mid-super growth price, that's 4.5 times book value, and the mid-growth price, that's 2.5 book value, flowing around what we call the super growth price, or 3.5 times its book value. However, that's really not how we look at Google, at Alphabet at all. What we really see is a stock which is trading either side of its fair market value, and it's been doing that for 10 years. Well, let's say that you are a market technician and you were looking at Google. What you might be doing is basically connecting the dots here in this stock over the past 10 years. And you would see, therefore, that the stock is just trying to break below that long-term trend. However, that's not the way we see it. We see it as a company that is fundamentally simply returning back to its fair market value. Now, if we have any luck, and let's say we had a fairly poor market for a little while, we might get a stock price that actually falls all the way back down to this 2.5 times book value low, which would give us an ideal long-term buying point. Okay, let's take a look at Facebook now. I'm going to show this stock up close and personal, and what you see is quite interesting, actually, really. Here the stock peaked precisely at what we call its bubble price. That's 7.4 times book value. And actually, this was the crash when all that bad news was announced. Now, the stock now dropped there. It did not hold, however, at the MSG price, which is 5.5 times book value, traded rather sloppily around that breakpoint, then fell another breakpoint, traded rather sloppily, and I think would have come all the way down to what we would assume to be its natural bottom, its super growth price at 3.5 times book value, but the market then turned right in here and has pulled the stock back up again. However, notice, despite the fact that the stock market itself has gone on from new high to new high, that Facebook has pretty much stalled out right at that MSG price. And I think that that may well be it. I'm hoping, I'm still thinking, actually, that eventually this company is going to get down as low as 3.5 times book value, its super growth price, and give us a superb long-term buy. Now let's turn to the heavyweight of the crowd, Amazon. And here is the long-term look at Amazon. Here's the company with a long-term sweeping up, rising from 7.4 times book value, actually all the way up to about 20 times book value here. Right now, it's trading at 16 times its book value. Let's look at this company again, up close and personal. The stock peaked out just a little bit shy, about 2% shy of its HB5 price. That was about 20 times its book value. It dropped one break point and then dropped another break point. Even that didn't hold, and I think this stock actually wanted to drop the third break point, which, by the way, would have carried the stock down almost 50%. However, the rally in the stock market intervened and has pulled the stock back over its technical support level. However, notice in that strength of the market ever since the bottom, Amazon hasn't been there. It's been just bouncing right along its HB3, which is about 16 times book value. And I suspect, given that action, I suspect that this stock wants to go lower. And remember, from that first chart, this would not be the first time that Amazon has had a big fall. Look at what happened back here in 2007. The stock fell from just a little over $100 way down to 34. That's a huge fall from grace, and it looks very much as if the stock is trying to do that once again. I would be very cautious of Amazon at this time. Here's good old Apple, and if I can go back and I'll look at the 10-year chart of Apple, I want to show you something quite interesting here, and that is to say that for most of the past 10 years, Apple has regularly peaked out at its MSG price. That's 5.5 times its book value. Look at that. Every time it hit, it peaked out until the very end, although even that breakout may have been caused by the fact that the company bought back stock, which you can see visually because the balance sheet has been falling away. So you had a rapidly rising balance sheet, flat, and now it's been falling a bit, although they haven't been buying stock back lately, so there's been a bit of rally in the balance sheet of the company. But note, however, that the company fell right back to its former high. I will be very interested to see what happens right now, because what's happening here is the fact that the fair market value, which is the earnings, are starting to slip. And in my experience, stocks do not reach new and excessive highs when their earnings are falling. Here's Nvidia. This was a wonderful company. It peaked out along, by the way, with Amazon and Netflix at its, in this case, at its HB4 price. Came down to support, failed. Came down to support, failed again. And look, by the way, when it failed, this is what we call sloppy trading, okay? Not precise at all. It fell down to the next price, again, sloppy trading. But look what happened when it got down to its bubble price, okay? That is very, very strong support, and this company found its feet and has had a nice bounce. And in fact, it's had two nice bounces. But the problem with Nvidia is that, unfortunately, the earnings and the fair market value are starting to fall away and may be in the process of pulling the company down with them. I would watch the stock very carefully at about the $130 mark, because if it breaks, it could go a long way. And historically, that has been the story of Nvidia. If we look back over the long history of Nvidia, we'll see that this is not the first time that this stock has had a big fall from grace. Look at here. Back in 2000, remember the great high-tech boom and bust? Well, that was not the only time it peaked out, because here in 2007-8, it had another big rise and then collapse. I think that this is about to do the same thing again. I think that the move has only begun. Okay, last on our list is Netflix. Now, this company has had a long rise, and look at it's getting more and more expensive in price-to-book terms all the way through this period from 2008 all the way through to now. This is an unstoppable stock. Or is it? Let's take a look at the history of Netflix, and we will see that this company is far from unstoppable. Look how fast the balance sheet was growing back prior to 2008, and then look at what happened here when the stock ran out of gas. It fell from about $35 all the way down to $7 down there before starting its cycle all over again. Now, let's take a look at this stock again up close and personal. See what's happened. It's had a nice rebound from that price decline. It didn't quite get down to strong support as I was kind of hoping that it would and give us a clean buy, but it's risen 2 break points. But look what's happened. It's absolutely run out of gas. And again, with the market very strong, Netflix has been able to advance any further. I would suggest to you that this stock has miles to go before it sleeps and not on the upside. Okay, if you're interested in learning more, go to our website, strategicanalysis.ca, for further information. We track over 4,000 different companies in North America, so the odds are that our analytical tools can be profitably used to improve your portfolio results, and more important, your confidence as an investor. This has been Ross Healy, Chairman of Strategic Analysis Corporation, reminding you that nothing, including investing, is difficult if you have the right tools. See you next time.